Welcome to the ETF Show, taped right here in Las Vegas at Vetify's Exchange ETF Conference. I'm your host, Kristen Myers, ETF Editor-in-Chief for Asset TV. I'm joined now by Christian Magoon, founder and CEO for Amplify ETFs. Christian, thank you so much for joining
Good to
me.
be here with you, Kristen.
So you and I are going to be speaking at this conference about the 60/40 portfolio. So I figured that was a pretty good place for us to start today. So the 60/40 portfolio has really been the bedrock of the foundation for a lot of investors. And yet there's been a lot of questions about the 60/40 portfolio. So I want to ask, are we witnessing an end to that model?
I really think we are. I mean, we saw in 2022, the 60/40 really behaved very similarly. And let's just back up. What is the 60/40? It's designed to kind of counterbalance each other during times of crisis and volatility. 2022, they both went down, right? So now we're in this new era where you have to rethink what comprises the 60/40. We think going beyond just stocks and bonds makes sense. Maybe it's different strategies in the bond space. Maybe it's some alternative assets. Maybe it's even some different equity strategies. So yeah, we think people need to rethink their 60/40 going forward.
Okay, so it's the 40 mainly that really
Yes.
people are rethinking. So what are investors replacing that 40% with
Yeah.
if they're moving away from the bonds?
Well, I think it's a lot of these alternative type strategies. Now, there's issues with that. And we know based on the headlines right now, there's also some serious liquidity concerns going on with some of these illiquid assets. So
Right.
we think that, one area that's just a slight shift that makes a difference is potentially looking at bond ETFs that also have the ability to write options. So not only do you get interest income from the bonds, but you can capture some of that option income. So for example, we have a TLT ETF. So we're holding TLT and we're writing covered calls on TLT to generate 1% a month option income. So now you have a TLT version, TLTP, that yields 12%. Well, yielding 12% gives you a lot more cushion
Yes.
than a current treasury that may yield 3.5 to 4%. So that's just one example of maybe a hybrid bond strategy that we're seeing people use.
So I want to ask you about alts because you did mention it.
Yes.
And I know you know a lot about alts. So alts have really been moving a lot into the ETF wrapper. And why do you think the ETF wrapper is such a good vehicle for alternative strategies?
So I would say that for some alternative strategies, it's a great vehicle because of the efficiency, whether it's cost or tax efficiency, the transparency involved, and then the flexibility, being able to potentially write options on those ETFs or intraday trading. The issue is, what is the liquidity of the underlying asset in that? So for example, we like some of the precious metals or mining stocks that are available in that alternative wrapper. If you look at commodities, for example, they've had some really nice returns this year and over the last 18 months. However, you look at kind of the other side of the coin, you can have some of these assets that are fairly illiquid and you can start to get, so to speak, locked up. And when you have an ETF vehicle that's trading minute by minute, but you have something that's only liquid one, maybe two times a week or longer, with some of these liquidity halts we're seeing not in the ETF space, but with these alternative credit managers, I think investors need to be wary. So, in my opinion right now, avoid kind of these, in my opinion, private credit, low liquidity strategies that are in the ETF vehicle, because we're seeing signs in the private equity credit market that are outside of the ETF space that maybe liquidity could be challenged going forward.
Right. That's a hot take that we will probably have to talk about on another episode. Sure. Since private credit is so hot right now,
Yes.
especially inside of the ETF space. You mentioned commodities. I'm curious to know what else you're seeing, what other alt strategies inside of that ETF wrapper are really gaining a lot of traction.
Yeah, so I'm going to say the crypto asset class is definitely in that mix now. And you can go out and buy the spot Bitcoin or Ethereum ETFs. We also would say that another area to access crypto is spot with covered calls. So that helps you mitigate some of that volatility that can sometimes be, hard to stomach. We've seen about a 50% drawdown in Bitcoin. However, if you're writing covered calls, that volatility actually creates more income for you. And we have a variety of strategies from Bitcoin to Ethereum, Solana, even XRP in this covered call format that allows you to access crypto, but maybe tone it down just a little bit, because most investors who are probably looking at 60/40, most likely their risk profile isn't to add a bunch of Bitcoin, but maybe Bitcoin with covered call exposure could maybe create a more low volatility option for them that fits better.
So I actually want to dive more deeply into that because I know that the Amplify suite has a lot of crypto exposed ETFs that you actually have had income on top of. So I'm going to get to that in just a second, but I'm curious to know, because you were mentioning the period of volatility, which that's the theme of the market in 2026, it seems. I'm curious to know if you think that really this market that we're in right now is really a place where alts can truly thrive.
Yeah, I do think so, provided there's underlying liquidity. I think alternative strategies that take advantage of options, they're one of the only areas that actually love and need volatility, right? So the more volatility in the marketplace, the more option income you can actually achieve. Most investors say, uh-oh, volatility, that's not a good thing. But one way you can take advantage of volatility is through option writing. Again, as the VIX goes up or underlying asset class volatility spikes, you can collect more option income. And when you think of what your total return is comprised of, yes, it's price appreciation or depreciation, then it's income. Many of these alternative asset classes don't have a lot of income unless you're using option strategies alongside that. So to me, it's a perfect time to look at alternative slices that have good liquidity, but also maybe one generation ahead of that, which is like the latest generation, alternatives combined with option writing.
So I want to now ask you about that crypto piece, because you guys have a lot of funds that have added income generation on top of crypto exposure,
Yep.
which is a pretty interesting twist.
Yeah, sure.
So talk us through a little bit about how that approach works.
Yeah, so we have about $20 billion of AUM. $10 billion of our AUM is in these kind of what we call yield smart products. Yield smart products simply mean option income ETFs that are balanced between capital appreciation and income generation through options. So there's a bunch of other products out there that I call yield traps, where they have very high yields and they're just writing calls to the extent where there's no capital appreciation baked into the asset class. We think that's the wrong long-term approach for investors. We think you need to have a rising NAV over time, not a depreciating, and attractive income, not the highest income, but attractive income. If you have the highest income, you're writing all your upside away. So what we've done with Yield Smart is really tried to have some level of coverage. Sometimes only 50% of the portfolio is covered, and the rest can go 100% upward. And the 50% that we cover, usually we're writing out of the money options that are maybe 5 to 10% out of the money, meaning the stock or the asset, the crypto could go up 5 to 10% before you're called away. So we think that balancing kind of this yield, attractive yield with what we call decent capital appreciation gives you this yield smart outcome, prevents you from getting in a yield trap, prevents you from receiving all your return from income, and then looking at your total return and saying, wait a second, why am I down? I have a 15% yield, but I have a negative total return.
Yeah.
Well, that's why you've really focused too much on the income. So this balanced approach, I think, is huge.
So I'm curious to know, one, how you're already seeing investors really think about crypto inside of their portfolios. And then two, when it comes to these, this income that's added on top of that, those crypto funds, I'm curious to know how that might change the calculus and how people are viewing that inside of their portfolio.
Yeah, so it definitely dampens some of the volatility that's associated with crypto.
Yeah.
So some people, that could be a non-starter. They really want that ultra low correlation and that kind of moonshot. The CFA Institute talks about 1 to 3% allocation to, for example, Bitcoin can really improve risk and returns over time. But the reality is many advisors may not want to go through a 50% drawdown of an allocation into Bitcoin, and having option income along the way to buffer that is a big deal. The other thing that's interesting about option income is the characterization of that. So most option income is treated as return of capital. So it's really not taxed in that year. Instead, it lowers your cost basis. So when you think of who's kind of looking at 60-40, it tends to be maybe people who are approaching retirement. Maybe they're looking for more income, but maybe they're in a high income bracket and don't want to have to pay the majority of that income away in terms of taxes. Return of capital is a great way to kind of circumvent that. You're ultimately going to pay taxes, but you're going to pay long-term capital gains if you hold that security for more than a year.
All right, let's talk thematics now.
Okay.
Another area that you have a lot of expertise in. How have you really been seeing investor appetite change for thematics over the years?
Yeah, so it's always interesting to see kind of how this is headline driven.
Yeah.
Even in the last week, we've seen a big uptick in cybersecurity. We have the hack ETF.
Yeah.
And with kind of Iran flexing its muscles and doing a few cyber issues, Iran and North Korea tend to be kind of our biggest problems when it comes to cybersecurity. And however, like a month before that, cybersecurity was sold off because of AI concerns. So a lot of headline kind of movements, but we think over time, many of these themes are really long lasting. So cybersecurity is only more important as AI evolves, as we go to a more digital version of the economy. You have to have that cybersecurity. I think there are a lot of themes out there. You have to make sure they're long-lasting and long-standing. We've seen a lot more interest this year in energy, of course. We've got a natural resources ETF that invests in oil, gas, and chemicals.
Right.
It's probably our best performer this year with what's going on in Iran. Some of the thematic is kind of timely oriented, or maybe more trade oriented, tactical, and then some of it can be long lasting, and we've got some of all of those products in our suite.
So to that point, how do you tell when a theme is just going to has short-term, upward momentum?
Yeah.
And how do you determine a theme that actually does have that long-term durability?
Yeah, so I think when we first look at a theme in terms of why we're going to launch something, we're going to look at a long tail, 5 to 10 years of a transformation of an industry. And remember, themes are unique because if you just sit in sectors or industries, sometimes themes overarch that. Like a great example is AI. Is AI just impacting technology? No, we're seeing it impact all these different sectors, all these different industries. So would you want a portfolio that actually kind of spans that and is not locked into a sector or an industry? So we need to look for themes that are going to transform over time. So we think areas like digital payments, artificial intelligence, blockchain technology, cybersecurity are major themes that'll play out over 5 to 10 years. Now, we have to say there are times where themes get incredible momentum, both upward and downward.
Yeah.
So there are times where, as a contrarian, looking at themes that have been sold off heavily really makes sense. So cybersecurity is a great example where the AI threat on cybersecurity sold it off as a great dip, and then suddenly the attacks start to come and cybersecurity stocks are back in the news, and they've gone up over 10% in the last several weeks here. So there are times to kind of maybe trade that or maybe average in. The other side is there are times when themes run unbelievably. So we have a junior silver miners ETF. It was up 185% last year. Maybe some time to take some money off the table and rebalance. Now I think it's up over 25% this year. So it's had some continued momentum. We think silver is going to go a lot higher from here because it is the kind of the most conductive electrical metal, and that's plays into AI, electrification, EVs, batteries. So that is a long-lasting theme, but you may want to look at price momentum to potentially pair back. Not many themes can go up 100% or more in a year. So I think being active in your thematic allocation for advisors and investors is important.
So on the AI piece, a lot of folks are really concerned that when they're investing in AI, they're way too concentrated in those, mega cap, those big tech names. When it comes to at least that theme, how do you think about capturing that beyond some of those really big names?
Well, Kristen, I love your question because we have the only equal weight AI ETF. We partnered with Bloomberg, and that was what the issue that we had with AI is that it is so market cap weighted and so concentrated, mostly amongst the hyperscalers. There's a few chip companies in there, but you're really making a big bet on their future investments. But what about the cooling companies? What about the switch companies, the data center companies? So our view of an AI product that in the ETF format is to own the space, but to equal weights. And there you can participate and have a core AI exposure. And then if you want to overweight NVIDIA, if you want to buy the Microsoft dip, okay, you do that with individual stock names. But again, we think just kind of having a equal weight approach makes sense. If you look at the internet revolution, having an equal weight approach made some sense. So many of the companies you didn't know who was going to win ultimately. And let's face it, some of the biggest companies now, market cap weighted, have some of the biggest price momentum and highest PEs. So you have to be careful of that. So we think equal weight makes a lot of sense.
So innovation-wise, there's been a lot of innovation. You've got income to private markets, which we chatted
Yes.
about briefly. I'm curious to know where you think the next wave of innovation is coming from when it comes to ETFs.
Yeah, so I do think prediction markets are probably going to be the next big thing. There's a certain amount of ETFs that have launched over the last 2 to 3 years that are definitely more for traders. Whether it's kind of like the next version of the 2x and 3x leveraged ETFs, a lot of these single stock products. I think we're going to move into the prediction markets. We've seen some filings for like a presidential election
Yes.
prediction market ETFs. But I think there could be other applications. If you look at maybe Polymarket, they're going to run maybe 30 to 40 markets on earnings, whether or not a company beats or doesn't beat earnings across 30 names. So could there be some intelligence coming from something like that where you
Right.
can bundle it and make it less of a binary outcome, or should I say a diversified group of holdings that have binary outcomes? There are a lot of creative markets in the ETF space, as you know. I think we tend to take more of the creative people than the mutual fund space. So I think prediction markets could be good. I think there's going to be more going on with crypto when it comes to active, potentially other yield products, not just option income, but staking, for example. There could be some other asset classes that strip out maybe like royalty payments from commodities, et cetera. So the sky's the limit. This new SEC is very friendly to innovation, and they're really willing to talk with issuers. And I think that's a welcome change. I've launched my first ETF 20 years ago in 2006 and seen several different SEC administrations. And I'd say this one seems to be one that is most pro business, or at least willing to talk. And we're in an era where there's so much disruption going on in the markets, prediction markets, crypto, even some of the ways ETFs might be able to be accessed, like tokenization in the future. It's pretty exciting times.
All right, Christian Magoon, founder and CEO of Amplify ETFs. Thank you so much for joining me today. And thank you for tuning in to the ETF Show.